All right, so thanks everybody who's joining us on this webcast live, and also to those who might watch this program on YouTube at a later date. You know, the bread and butter of our platform at EvaluSys continues to be the Business Wellness Diagnostic Series and its ability to reveal growth opportunities through improved management and leadership discipline. However, today's program is going to be focusing on our premium solution, Value Growth Architecture, which is a perfect complement to our evaluation tools. We'll show you how that, why we say that here as we move along through the presentation. If you have questions as you go along, please use the Q&A box at the top. We'll be collecting those, and at the end we'll have a Q&A break, and I'll hit as many of those questions as possible. And if there's any I can't get to during this 45-minute session, I'll be sure to follow up with you afterwards. So let's get going here. So Value Growth Architecture is all about growing business value. That's what it's about. I know a good number of M&A and business valuation professionals, and as the founder of the Exit Planning Exchange chapter in Charlotte a few years back, I talk to people all the time whose job it is to know what business buyers or investors value in prospective acquisitions. So the thing I hear all the time are, financial management is important, have your financial square, sound operating processes, and having a clear vision for how to improve the business month after month and year after year. So how does Value Growth Architecture help this? Let's talk about that. Really fits hand in glove with those principles, enabling a finance-driven, disciplined operating process for strategic planning and value engineering. Value Growth Architecture, or VGA as I'll refer to it, VGA demands a focus on prioritizing investments in value growth initiatives based on return on investment and aligning those activities of the company towards growing the transferable value of that business. So if a buyer comes in to look at a company and can see that the level of planning and discipline is there, and they've got a track record of achieving growth goals, they're going to be attracted to that. In addition, if the owners are confident in their ability to grow the value of the business, that's actually a significant negotiating advantage for those business owners. So let's move along here. So this is the process in a nutshell. I mentioned earlier that VGA is a perfect complement to our diagnostic series because those evaluation tools identify their prospective value growth ideas on the front end of the growth planning process. So once you've seeded that process with growth ideas, VGA has you cherry pick those items that you believe the greatest opportunity for value enhancement might be, and put those into your growth actions list, where you'll have the financial tools to forecast how each of those actions will contribute to value growth. You'll assess the cost of executing those actions, leaving you with the return on investment information needed to prioritize and to schedule implementation into a multi-year growth action plan. So that's the value growth architecture process. So let's dig into that a little bit more. We talked about the evaluation tools, our business wellness diagnostic series. You can see on this slide our current collection of evaluation tools, which we intend to continue growing year over year. Last December, in December 22, we released our new supply chain and logistics evaluation designed for us by Brian Snodgrass, who's a very talented supply chain and logistics specialist based in Texas. So you can find my recent interview with Brian on our YouTube channel if you like. If any of you would like to see other evaluations be added to our diagnostic series and would like to partner with us to design those evaluations, please contact us. I'd love to hear from you, hear what your ideas are, where are the gaps in this collection, and how could you perhaps be a subject matter expert to help us design a really robust addition to this program. So what happens after you add an item into your growth list? You develop a growth action profile, and it really answers the foundational questions of what needs to be done, how long it'll take to complete, how will successful completion of that action impact cash flow and earnings quality, and what will it cost to complete that action? That's the fundamental information that we need to collect as we're going through the planning process in VGA. With that growth action profile completed, you're going to have the financial details needed to understand the value contribution of each growth action that you've prescribed and each of their returns on investment. So with that information, you're ready for growth action planning. I'm going through this pretty quick, and I understand this is just intended to be an introduction. Look forward to, again, answering any of your questions when we get to the Q&A session. So the growth action plan is pretty complete. It's got what are the growth initiatives that the company needs to tick off in this effort to grow the value of the company. What are the dates in the schedule? What are the start dates and end dates that you're targeting? Who are the responsible leaders who are going to lead these initiatives within your firm? What's the value contribution amount for each of those initiatives? And what is the budget that is necessary in order to be able to implement that? So let's dive into how all this works in EvaluSys. We're going to buzz through this pretty quickly, and I'll be sharing some EvaluSys screenshots during this introduction. But happy to, at a later point, actually dive in and do a demonstration for you one-on-one or as a group. So we start off with the VGA client profile, and it summarizes the architectural program status for the advisor. This is an advisor view. There's a separate client that I'll show you some illustrations of as well. But this is the advisor view, and frankly, this is a scrollable screen, and on the slide you can't scroll it. One of the disadvantages of not doing this thing live on the system. But the next few slides will show some of the components that also show up on the lower portions of that dashboard. So this is the overall profile. Part of what we do when we start value growth architecture engagements is to devise the planning team. Who are the value growth architects that are going to collaborate on this process? It might just be perhaps yourself as the leader and facilitator of this program. You might want to have the leaders of the client leadership team, the CEO, the COO, other key participants in the leadership of that company as part of your architect team. You might have some outside professionals, some outside specialists who maybe have marketing or sales or finance specialties. You can use our platform to be able to bring all those people into the platform, allow them login access to create their growth actions, and collaborate over the definition of value contribution that I'll show you later. So it's important to determine who's all going to be participating in this process right up front. Next step is to develop your list of cross-functional value growth actions from the evaluation results and beyond, because the business wellness diagnostic series is a vital source for growth ideas that will begin to populate ideas on what can we change to improve management disciplines within the firm and therefore produce a value lift for this business. So that's a great way to begin to populate. But if there are specific ideas that are outside the scope of those evaluations that you feel are appropriate to add to your value growth actions list, there's an ability to do that. Let me see if I can get my little highlighter here, laser pointer. You can see that this plus value growth actions button is there at all times for you to be able to add your own ideas from a blank sheet of paper. It'll go right alongside those that you collected through the diagnostic process. So you're going to be developing that list, and you're going to be creating that value growth action profile that we talked about earlier in the program. There's a lot of just basic information. What's a title for this action? what functional area of the business is it in, who's it assigned to within the organization, within the evaluation, or the within the architecture team. Short description, long description, and here's one of the key pieces here. What is the duration for completing this? How long will it take from start to finish to be able to execute this action that you're proposing? Some other items that you can put in: the benefits, the outcomes, the participants. But once you've saved that, you're going to get into more of the financial aspects of defining the value contribution. And that's where we're going right now. First step is to identify what is the earnings contribution. Now, this technically, earnings is a proxy for whatever the valuation metric is for this business, whether it's being valued based upon EBITDA, or it's being based upon net income or recurring revenue. All is going to differ from one company to the next, or one industry to the next. But earnings is sort of a proxy for that. So in this case, if this company is focused on EBITDA growth, what are the ways that this particular action, reducing purchasing variance, is going to influence a growth in EBITDA? You can see at the bottom here, we've got one item here: reduce pricing variances, and it's identified to impact direct materials and reduce that by 3%. So that's one of the items. You can stack these items because any particular growth action could have multiple positive ways that it'll influence EBITDA growth. There's also a chance that there might be some offsets to that. There might be some incremental expenses that you'll incur. So, for example, in this particular case, if you're reducing purchasing variances by implementing additional technology controls over procurement, maybe you have an additional incremental cost of licensing for the ERP software. If that's an ongoing cost, you would add that as a separate line item underneath that reduced pricing variances item as a negative to that. So that way it'll net out the net EBITDA improvement that would be resulting from this implementation of this action. So moving forward here, the next step is to look at earnings quality contribution, and this is more about risk. This is all about the predictability of future results for that business. And as part of, and I'll talk about some of this, the details of this a little bit later on. On this screen, there's a current multiple that's going to be based from a valuation that's performed outside of our software. So you'll need to, when you're working with clients, make sure you have that availability to do a valuation. Or I'll be talking later about how we're developing a collection of partners that we can refer you to be able to get valuation information that would populate the information within EvaluSys. So what we're trying to do here is, a part of that definition is going to show you various tiers of EBITDA and what the maximum multiple is going to be at each various tier of EBITDA. So the market's going to reward larger companies, and therefore you're going to see a larger multiple as you get at higher levels of EBITDA. But in this case, if the company's moving from 2x to 5.5x, it's going to produce an estimated $24 million in earnings quality contribution. And what we're trying to do here is to be able to allocate that $24 million in an appropriate manner across all of the items within your growth actions list that have an effect on the predictability of future results and the earnings contribution, or the earnings quality of the business. This quality impact score is used as a slider, as a weighting factor. So we know that not every change that you're going to make to the business is going to have an equal impact on risk. So this is a subjective way that you can alter the allocation of this $24 million across the collection of actions. If it's zero all the way down to the left, meaning it's not going to have any effect. It's not going to get any allocation of that $24 million. If you slide it all the way to the right, 100, it's going to have a dramatic effect on that. So you want to leverage your understanding of the market and the risk involved in a business, and be able to use that thought process in deciding how to move this quality impact score up or down based upon the particulars of this action that you're looking at. Each of these items has some timing that you can mess with as well. In this particular case, it's showing that 5 quarters after the action that we're prescribing is completed, this earnings quality contribution will begin to show in your projections. You've got a similar kind of timing on the earnings contribution side as well. So moving on to the action investment piece, this is simply the one-time costs of executing this action that you're prescribing. And you're just going to be plugging in whole dollar budgets by quarter. And of course, these quarters is going to align with the start of that action, regardless of where it is scheduled over the coming months and years in your plan. And we'll get to that planning process shortly. So it could be consulting fees, if we're talking about the implementation of an upgrade to the ERP. There could be some training costs, some one-time training costs that would be involved. That would be a one-time item here. Who knows what some other items might be. You can stack those up and it'll aggregate those investments, because ultimately what we're driving for is calculating a return on investment that can be used to prioritize action. So if we look back at this profile tab, you're going to see this value contribution summary pop up once we've got the financial particulars in place. So you can see we have some metrics on net cash impact, annual earnings impact. We've got earnings quality, we've got total value, and we've got the investment that was prescribed. The percentages after these are the return on investment percentages, and you can see we've got 3-year and 5-year numbers in this summary. But as you'll see later on, the system calculates 1, 2, 3, 4, and 5-year figures in each of those categories, and you can use all those metrics as a way to prioritize action.
No, I made the mess, but give me a little time to pick it up.
So let's move along here. Now we're getting into value growth action planning. So this is where we start with, we've identified the budget to implement each of these ideas. How much money are we going to set aside for this company to be able to apply towards those, to implementation of those initiatives? So again, here's a budget. In this example, we've assumed $20,000 a quarter. This is something that you can kind of do what if through your planning process. If it looks like there's a lot of return on investment that you want to leverage and you're willing to up that quarterly budget, that gives you an opportunity to accelerate achieving that value growth. If you decide that you want to be a little more conservative, you can tamp that down and reduce the quarterly budget. But the way that the system will schedule out these initiatives, it won't violate that budget that you've prescribed here. Next step is to take that budget and go forward with prioritizing these actions. You can see in that pop-up here, or the drop-down, here's all the different metrics that you're going to be able to use to sort this list as a preface to locking in priorities. What you're trying to do is you've got a list of 12 items in this case that are part of your action plan. You want to lock those into a priority 1 through 12. in order to be able to establish the sequencing of these as we move into the scheduling part of this process. So common approach might be to prioritize initially by a cash metric here, maybe like a cash ROI 2-year metric that will sort this list by decreasing cash ROI. And then you can lock in a few at the top. The reason why this is popular is because that gives you the ability to front load some initiatives that are going to produce new cash flow into the company. And what that does is allows you to build up some additional resources that can be then used, reapplied to pay for the investments in the value ROI items that many times will not have a short-term positive cash flow, many times a short-term negative cash flow impact, simply because many times you're improving management discipline, you're adding additional management talent into the organization, investing in some other, software and documenting business processes and that kind of thing. So that'll have a dramatic effect on the value of the business, but early on in the cash flow, it's probably going to have a negative effect.
I finished this.
Please make sure to mute yourself if you would. Thank you. So the next step is to go through the scheduling process. And you're using this action scheduling tab in order to be able to complete that.
Some help from you.
We're just going to pause for a second here. Let me see who we have. We need to mute here. We've got, I think we got everybody muted now. Very good. So again, we're all about scheduling now. So we've got the budget defined, we've got the prioritization defined. The system will be able to very easily place those into a schedule, target, start date, end date, by just pressing this initialize schedule button. So it makes it really easy if you want to do some what ifs, go back and change the budget assumptions, change the prioritization scheme that you've used, reschedule it. Just in a matter of moments, you can look at different approaches and different schedules for the implementation of this. So once you're done with that, you can export this schedule. You can use that within perhaps a project management software platform that will help provide tools to be able to ensure that you complete these initiatives on the schedule that's identified. EvaluSys today does not provide that project management level, but it certainly supports exporting the information that's an outcome of your growth action planning, so that way you can use that as within whatever tools that you choose to use. The last stage here is action tracking. What we do suggest you do is keep tabs with the progress that the business is making in implementing those items, and go in and add the actual start dates and end dates as they transpire. That way you'll be able to see on the reports that are generated on the dashboards that the clients have, you'll be able to see the amount of value that's actually been realized by the successful completion of these actions. So let's take a look here at what some of the reports are going to look like. Again, this is cut off. This report will slide down here. It'll show you a little bit more about the net cash impact to the business, just overall. This report is a growth summary that's an aggregate on the impacts of all changes that are reflected in your growth action plan. So that chart shows you the growth trajectory. That's the result of successful execution of this. Down here, you can see that funding your growth program. This gets to that notion of prioritizing some cash ROI items at the top of your list. By doing that, that gives you that opportunity to have the program self-fund itself after a certain point, after the the new sources of cash flow exceed the growth budget or the investment budget that you've prescribed, then effectively the program's paying for itself. That's a very attractive feature for clients to be able to see. So again, this is the overall report. There's additional reports for each individual growth action. And these align perfectly with the information that's available to the clients on their dashboard. If you allow the client to have access to the dashboards, that's again a choice that the advisor can make. Who gets access to the process, who collaborates as part of the growth action planning process, who has ongoing visibility to the dashboards to see where we're at in the growth execution process. Next here is, this is what it looks like on the client side. So this is the dashboard that a client would see once they're provided access to value growth architecture. It has that same high-level executive summary. The company is going to grow from 7.9 million to 31 million in 3 years, 38 million in 5 years. Shows the return on the ROI there, or that growth percentage. What is the budget needed in order to be able to execute this growth program? Over 5 years, they need 257,000 in this example. There's 12 critical actions needed to grow cash flow and improve or reduce future earnings risk, and it's going to result in a 3.5x increase in the multiple. Here's where it shows the distribution across functions within the organization. There's a tracking chart that shows up once the program begins to execute. Basically shows you the difference between what was initially planned versus what is actually happening based upon late or early start or late or early completion of these initiatives. And again, by clicking on this growth actions list, they're going to see a list of those growth actions and be able to click into dashboards that look like this for each of the actions. Again, this resembles the reports that can be produced in PDF format and put together in a document if you prefer to provide some hard copy output for the client in their program. However, on this dashboard, they're going to be able to see the priority of this particular item, target start and end dates, and that value contribution summary that we saw on the advisor's view. So really great information to support the ongoing execution and the ongoing investment in this growth program for the client. Now, one piece that really is is part of the configuration of value growth architecture for a particular client has to do with, there's some financial configuration. What are the financial metrics? What are the P&L items and the balance sheet items that really speak to the value of a company and how that value will grow over time? So part of our configuration that you'll go through is defining what we call metric classes and uploading baseline data attached to each of those metric classes. And that provides the foundation for these growth actions to forecast the improvement from those baseline values. There's also some market valuation information in there. I showed you where there's a plug for what is the current multiple for that business. There's also that chart, that table that will show you the tiers of EBITDA or whatever the valuation metric is, and how increases in that metric will be rewarded by a higher multiple level. So all that information needs to be provided by someone that really understands the market. And that might be you all, it might be you. You may have an investment banking background. You may have that expertise. You may have tools that you feel comfortable using to be able to do those valuations, but you might not. And so what we're beginning to develop is this national valuation advisory referral network for EvaluSys. So ultimately, if you become a Value Growth Architect member, we're going to be able to direct you to some resources that we know and trust, and you can trust, that would be able to provide some input to each client engagement, identifying a valuation for them, identifying what that industry looks like in terms of the tiers of EBITDA or recurring revenue and the corresponding maximum multipliers. So they can also perhaps provide some ongoing advisory support to look at some of the changes that are being proposed, to look at some of the output of the assessments, and help to identify those items that have a significant effect on risk or would be a significant driver of earnings growth. So I want you to understand that you may or may not need some support as an advisor using value growth architecture, and we're setting up to be able to provide some recommendations around that. And if you happen to be someone that would be a potential candidate for this National Valuation Advisory Referral Network, please make sure to reach out to me. I'd be interested in talking to you in more depth about how that works. So before we get into general Q&A, I'll go through a few frequently asked questions. So can EvaluSys and VGA be white labeled? And the answer to that is absolutely yes. And there is no additional cost for that. So the reports can all have your branding on it. The screens can all have your branding on it. The login screen can have your own customized branding on that. So that adds no additional cost. By the way, even if you're a basic advisor member, not a value growth architecture member, that branding is available for everyone. So do we support additional currencies other than US dollars? And the answer to that is yes. For the reports, for the screens, the output can be shown in a variety of different currencies. So if you're working with people in Canada, or you're looking at people in Europe and have euros or pounds in the UK, any variety of currencies we can be able to customize simply by changing an option on one of the screens. So how much time does it develop a value growth architecture for a company? And of course, the favorite answer is it depends. It really depends on how many people are going to be involved, how granular you get in doing your planning. By granular, I'm meaning you could go just high level and just focus on how will this change affect net earnings? How will it affect operating expenses? Or you can get down to product line level projections in terms of how will this new project or product or service contribute to value growth over the next 5 years. So you can get as granular as you want to or as high level as you want to. That's completely up to you, and that will dramatically have an effect on how long it'll take you to go through this process with a client. So estimates might be 2 weeks on the short side and maybe 3 months on the high side. A lot of it also depends upon the availability of client leadership, because you're definitely going to want them to be involved in the process to some degree. So 2 weeks to 3 months, that's a good idea. Couple other frequently asked questions. So can the company leadership teams use EvaluSys and VGA without outside support? So do they need a consultant or a facilitator to be able to do this? I've always thought, yes, they should. But right now we're happening to be piloting a case where the internal finance and operational leaders for a company here in Charlotte, a middle market company in Charlotte, North Carolina, are piloting value growth architecture within their company. And it'll be interesting to see how much outside support they might need. But I still think that 99% of the time is going to be led by folks that have that strategic planning background, that ability to be able to facilitate a process, and ideally have the vision in terms of how value will be affected by changes that are being proposed in your plan. So last question in our frequently asked questions section, how much does it cost? That question always comes up. And that, again, it depends. It depends upon how you choose to use the platform. As a pricing philosophy within EvaluSys, what we try to do is to keep the minimum financial commitment to use EvaluSys low on a month-to-month basis. So your subscription costs are very modest. And then when you begin to use more and more facilities within EvaluSys with clients, and you're getting cash flow from being engaged with those clients, then the costs of using EvaluSys are going to be ramped up. So if you add additional people who are going to be logging into EvaluSys, you're going to have VGA team licenses that you'll be using. And each of those is $50 per month. And again, you'll apply that while you've got those people engaged in the process, and you'll ramp that back down after the project is completed. It also depends upon how many evaluations you choose to use. If you use 10 evaluations, it's going to cost about $790 in license fees to be able to use those evaluations with a client. But as you can imagine, those EvaluSys costs are really insignificant compared to the fees that you're going to be able to charge the clients to help them achieve this value growth. And of course, the return on investment these clients are going to get from being able to actually achieve that value growth over time. But in a general sense, you can estimate between $1,000 and $3,000 in EvaluSys fees for each growth architecture engagement. That excludes, there's a one-time training cost of $19.50 per advisor. So that's a one-time cost that will get you into the training program for EvaluSys. So when you register for EvaluSys, that will be a fee that will be collected at that time if you're choosing to register as a VGA member. Let's see here. So now we're into the general questions and answers. And let me bring up the Q&A list, see if we have anything on our Q&A list. Nothing yet. At this point, if you'd like to open up your mics and offer up any questions that you might have or any comments that you might have, that would be fine. If not, we're approaching the end of our 45-minute schedule. So what I will do then is to simply end by sharing some next steps. So next steps would be to go to EvaluSys.com and register as a Value Growth Architect and get scheduled for Value Growth Architecture training. If you prefer to just kind of begin the process by starting with a basic advisor level and get used to some of the diagnostic tools, that's a smart way to begin to get involved. So you can, if you're going to be registering as a Value Growth Architect, you're going to be pressing this button off the membership plans page on our website. If you're going to be doing the basic 15-day free trial, there is no free trial as an architect, but there is as a basic advisor. You can sign up for that by simply pressing that button, and there will be no costs initially to be using EvaluSys, as long as you're not going to be wanting to use one of our licensed diagnostic products. There's a couple of products that I've talked about in prior webcasts that deal with helping to do business development for your advisory practice. There's a business wellness checkup tool. There's a exit planning assessment that doesn't have any incremental costs, so you can, with a $39 a month basic subscription fee as a basic advisor, you can use unlimited use of that business wellness checkup, which provides a triage across all functional areas of the business. Or you can use the exit planning evaluation as a great conversation starter to help a business understand how unprepared they are for a prospective exit. So with that, I will simply invite you to also to go to see us on YouTube and subscribe to our channel. You can see some of those other past webinars. You'll be able to see the recording of this webinar and review that at a later point. Please connect with me if you're not already connected to me on LinkedIn, and email me at tombixby@evalusys.com if you have any questions about value growth architecture, EvaluSys, or anything I can help you with. So with that, I'm going to thank you very much for being a part of our audience today, either live as a part of our audience or watching us on YouTube.